So first, let me try to understand the team.
If you have very similar style or similar stocks, then if one person fails, it's like single point of failure. So again, going back to the independence philosophy, we actually are very, very flexible.
I would want to understand more on one subject, which is your favorite and where we all track you a lot, which is small cap. Every market cycle comes with a lot of stories. There are certain stories to feel excited about, and there are stories to be afraid of. And as an investor, we are always confused which stories to rely on and which stories to avoid. To handle this, we have our new episode of Market Mavens. I am delighted to be joined by Mr. Manish Gunwani, who has 30 years of experience handling Indian equity market. Mr. Manish Gunwani is the CIO of Bandhan Asset Management Company. He had illustrious career. Before Bandhan, he was the CIO equity for Nippon India Mutual Fund, and prior to that, he was deputy CIO at ICICI Prudential Mutual Fund. With a cool demeanor and a calm perspective, he has built his reputation as a first principle thinker, where his portfolios have reflected his ideology. We live in a world where news change by the minute and where confusions and narratives are over and above the data points which we see. So we have his wisdom to guide us through all the chaos of the market. Welcome, sir. Welcome to this podcast.
Thanks for having me.
So, sir, starting with a broader philosophy, since you have been at senior position in a couple of other asset management companies, so just to understand, uh, are the structures, the way investment happens, investment philosophy, same across the industry, or are there distinct elements to Bandhan AMC? So, if you could help us understand that in a broader way.
Yeah, I think when you look at different AMCs, I think of three factors or attributes where each team is different. First is risk management in terms of uh, how much of risk you're taking with funds. Are you taking too much macro risk? So there are parameters like active share or cash calls, etc., which you can use to track. Uh, we generally believe at Bandhan that we should control our macro risk, but that may not necessarily be everyone's view because obviously when you control risk, you're also letting go of supernormal alpha. So I think each AMC is on that spectrum of risk management versus supernormal alpha. How do you balance, right? So I see typically what happens is small AMCs take more risk. That's what you see. But I think it also depends on the DNA of the team. The second is thought independence between fund managers or between fund manager and research. So you could have some houses which have a bit of a style orientation or a sector orientation, etc. Right? We try to be as independent among fund managers or fund manager versus analysts. We keep it very independent, but that's again a choice, right? We just do it with a view that from a scalability perspective, I think it's good for the firm to have different thought process because if you have very similar style or similar stocks, then if one person fails, it's like single point of failure, right? The third dimensions where I think AMCs differ is how do you measure performance and how you prioritize output versus input. In the sense that you can either be very input centric, look at how many meetings someone did, how many hours you spent in office, or you look at only output, which is the outperformance or alpha generated by analyst or fund manager. We tend to be very output centric because we feel this is a business where you can create outperformance through a lot of different styles or behaviors, right? Someone can be very good at evaluating management, someone can be very good in doing channel checks, someone can be very good in reading annual reports, doing desk research. So we don't get into how you create outperformance. So we are very output centric. So I think when you see these three philosophical traits, you can make out how AMCs are very different from each other.
Right. So you mentioned about team, you mentioned about risk, and you mentioned about output. Let me take these one by one.
Right, right.
So first, let me try to understand the team. So you would have a coverage of good number of stocks. So if you
Yes.
could take us through what numbers of stock you cover, what is the kind of team you have, and also how much is the reliance on sell side and how much is in-house research.
Right. So we cover approximately 700 stocks. We have 10, 11 people with research responsibility. Someone may be pure research. Someone may also be doing some co-fund management, in which case the coverage may be a bit less. But yeah, that's the team structure. I think it's not probably very different from top 15 AMCs. But I think the difference also comes in the way you incentivize the research team or the fund management team.
Right.
So one is, for example, we are very uniform in saying that our sweet spot for measuring performance is 3 years. Now, some other AMC may be 1 year, someone maybe 5 years, but we feel 3 years, 3 to 5 years is the sweet spot. Active investing, fundamental wise, I don't think can be done for a 6 months to 1 year horizon. Beyond 5 years, very difficult to envisage how the macro looks like.
Right.
So that's the way we structured that. We measure broadly on an average 3 year performance. Uh, Team, I think size is important because over last 20 years, the number of stocks which have got listed, the number of stocks you need to look at to beat a benchmark like Nifty 500, for example, has obviously gone up a lot.
Sure.
So I do think that one of the advantages of being a reasonably large AMC is that you have the resources to invest in team. You have the resources to also get a lot of inputs for the team. As you said, sell side is a big input for us. So we have most of the good brokers where we have access to. But having said that, when you ask me sell side versus internal research, as I said, since we are very output centric and we run research independently and fund management independently in terms of appraisal, etc., we don't get into whether our analyst is talking a lot to sell side or not using sell side at all. We just leave it to the individual, whether the fund manager or analyst. How much input they're taking from sell side is not something we actually monitor.
Got it. So now you have been mentioning about independence of team, and that's something which we don't often hear.
Yeah.
Now, my next question is A about you and B about the team. When you speak to fund managers, a lot of them have certain no-go areas. Some of the fund managers
Yeah.
would say, "I would not touch PSU."
Yeah.
Some other would say, "I would not touch new age companies which are loss-making."
Yeah.
And then there would be someone who would say, "I don't believe in turnaround stories."
Yes.
Do you have such exclusions at your end, at your team's end, whereby you say that these are not the areas where we would want to venture into?
So again, going back to the independence philosophy, we actually are very very flexible at a top down line in the sense that we don't have a process which says that we will avoid loss making companies. We don't even have a process, to be honest, saying that we will not buy companies whose perception is management is not great, because we feel everything has a price, right? um, Again, the individual fund managers will invariably have a style. Like my team may have a fund manager who's very quality conscious, doesn't mind paying high valuations based on management and business quality.
Right.
At the same time, we have fund managers who are very contrarian, who don't like to pay very high price to book or price to earnings.
True.
As I said, our philosophy is let them be. Of course, we obviously don't want corporate governance issues in our investing company. That's the only red flag in one sense. But whether the style is momentum, quality, contrarian, we really don't do anything top down to restrict it. Our risk management on funds is through what we have this fund casing,
Right.
which is more about restricting macro risk. So, for example, a very simple part of the fund casing is active share. How much are you different from the benchmark?
Right.
So, broadly, we don't like active share being below 35-40% or it being more than 70-80%. Because if you're too low in active share, you will struggle to create alpha because you're very close to the benchmark, right? Um, But we also don't like more than 75-80% because invariably what happens is if you have very, very high deviation from benchmark, effectively it becomes a top down call. Like if you make a big sector zero and if it's an export sector, then if rupee depreciates, you will underperform. We don't like taking those acute top down calls, which is why we like active share to be within a range. So that is what I mean by risk management. But we will not manage risk saying someone should not buy high P stocks or someone should not buy low quality stocks. We don't really get into the fund management style on that perspective.
Got it. So you mentioned about active share. My next question is about that. And here I'm talking about two specific funds, large and mid cap and small cap.
Right.
So when we look at your portfolio, without getting into which stocks do you have, in large and mid cap, you have close to around 115 stocks. In small cap, you have close to 240 stocks. So as an investor, when I look at your portfolio, there are two, three doubts which come to my mind. A, having these many stocks, am I differentiating the portfolio from index or I'm just index hugging? Second, is it possible at the fund management team to keep a track and manage this efficiently when you have this kind of stocks? And thirdly, when you have these number of stocks, obviously there will be a long tail of allocations
Yes,
where it would be
yes.
0.5%, 0.6, 0.7%. And even if one of those ideas become 10x in next 2 years or 3 years, does it add as a kicker to the portfolio? So how do, as an investor, I should look at these portfolios?
Right. We get asked this a lot. So there's a very long list of reasons why we do this. I'll try to summarize it. So one is when we have long list of stocks, it's partly because, as I said, we try to minimize top-down risk. So we're there in every sector,
Right.
there in every style. So one that leads to a longer portfolio. Two is I think more than looking at number of stocks. If you look at active shares, our fund active shares are quite high.
Right.
So really, the outperformance in some way is a bit correlated to active share than the number of stocks because if I'm different from the benchmark, then my performance will be different from the benchmark. Whether good or bad, we don't know, but obviously we will have positive alpha or negative alpha, but there will be some alpha.
Right.
Thirdly, I think it's good for scalability. See, if you give me money for 10 years, saying I'll not ask you any questions, point to point, produce performance over 10 years, and no inflow,
Right.
right? Then I may also have 20 stocks and sit on it, right? The point is, when you get flow every day, I think you have to be very objective about what to do with that money, right? Because if you see historically, a lot of funds where they go wrong is they do well because a set of stocks they own do well. That gets them money. But if you keep buying those stocks, as a general rule, if a stock has already done well, it's less likely to do well in the future, right?
Right.
Not 100% rule, but that's a broad correlation. So if I get money, let's say 100 rupees every day, I should be fair to that 100 rupees and say today what is the best risk reward stock, and more likely it may not be what I own,
Right.
right? Then why not go buy a new stock rather than buying something which has already done well, which is probably expensive. So I think you have to see the context that we are a open-ended fund.
Right.
We hope to get money continuously, and if we have to do a good job of that inflow, then we need not be we should not be biased for what we own. At that, I'm not saying that always a new stock makes sense. Obviously,
Right.
sometimes what you own may also be good from a risk reward perspective. But I think it's necessary to be fair to that incremental flow, which is why I think it's okay. And your question about does it move the needle, etc., you should remember that someone has skin in the game on that. As I said, we are fairly team led, right?
Right.
So let's say in small cap fund, I have a position which is 0.1%. Um, on the face of it, that 0.1% may not look important.
Right.
But 2 points here. One is, first of all, what that 0.1% that stock, as a team, we may own a big amount,
Right.
maybe in different funds.
Got it.
And two, more importantly, see, for the analyst who has that in in model portfolio, or we have a small cap focus list portfolio. Um, Even if it's 0.1% for the fund manager, it might be big skin in the game for the analyst, right? So it's not like we are owning something where no one is looking at the stock, no one is doing good work. There is a fairly big team behind the funds, and they are incentivized to do well in their model portfolios and small cap focus list. So there is someone whose neck is on the line in a sense, right?
Right. So you are saying that from a bandwidth point of view, also it's not an issue because the analyst would have recommended that fund
Yes.
to three fund managers, and each one of
Yes.
them would have some exposure there
Yes.
for it. So you mentioned very interesting thing in your conversation that a stock which has done well for 2 years may not do well for third year. That's called curse of performance. And now I flip the question.
Yes.
You have had a stellar track record for last 2 to 3 years. Uh, there are a lot of data points which corroborate what you mentioned that no fund remain in quartile one for an extended period of time. After 2, 3, 4 years, there is bound to be underperformance. Now, as an investor, I am confused. I have allocation in both your large and mid cap and small cap, which have done well. I want to add more.
Yeah.
Should I keep adding in your funds, or should I look at that fund which has underperformed in last couple of years, provided fund management processes and all is at par with what you have here? What should as an investor I should do?
So this is again a very important question. One is obviously then you should start looking at longer time frames. We've seen very good fund managers who've been there in the industry for 20, 25 years. And a lot of them have got phases of 3, 5 years where they haven't done well, but then they've come back. So one is rather than looking at 1 or 3 year performance, look at 7, 10 years performance. That is one way out. Second is, as you rightly mentioned, it's not just about performance. Like I always encourage distributors and investors that you should ask how big is the research team. You should see one key metric I look at when I see a AMC is how different are the funds in terms of the stocks they own. Because
Right.
for me, if a set of 30 stocks is driving the entire performance of, let's say, a 2 lakh crore equity AUM house, I'm very, very concerned because
Right.
that means that A, all fund managers are thinking alike,
Right.
and B, those 30 stocks already are very, very big illiquid positions, and they've not been able to find new ways to create alpha.
Right.
See, for scalability, you can't be very momentum driven or very growth driven or very quality driven. You need to have a bit of skill across styles and across market caps, across sectors. So I'm very concerned or skeptical about houses which say I'll never do PSUs, I'll never buy metals. Uh, I think if a house has to scale up, it's good to see heterogeneity of thought. You want to see funds which are very growth oriented, but you also want to see funds or in the same portfolio. What I like to see is a loss making internet platform
Right.
and a point 0.5 book
Right.
company.
Right.
If those are there, then I like that portfolio.
So very interesting. And my next question is about that. There is something called house view, which we all studied in our academic books to go by, and there are different kind of house views. So one view could be that at this point of time, I am negative large cap IT services, and there are a good number of fund houses which are doing that. Some
Yeah.
would say that I am negative on, like you mentioned, metals and all. So if I look at the current market, what are those sectors where you are extremely negative about, and what are those sectors where you are relatively constructive at this point of time?
Right. So negative in general, I find consumer companies very expensive. Again, it's not that I'm not positive on consumption from a macro perspective. I think we will get a bit of recovery from fairly sedate kind of consumption trends we've seen over last 2, 3 years. We may get a mild recovery. Uh, but when you look at a lot of consumer companies, versus where they are trading globally in terms of valuations, or more importantly, in terms of market caps.
Right.
right? Both for consumer companies, auto companies, our market cap seem very high to me.
Okay.
Especially because two things, right? I mean, last 20, 30 years, we had very high nominal GDP growth of 13, 14%, which is not going to last because inflation is down structurally, right? And second is our demographics are changing. So if you see last 20, 30 years, a lot of consumer companies grew by penetration.
Right.
That is to a certain extent peaking out now. That our population, especially in the richer western and southern states, is not growing very fast.
True.
Birth rates are much below 2, which is needed to kind of increase population. So, so I do find challenge investing in these kind of companies. Um, where I'm positive is basically one. I think the financialization theme, the capital market theme, it will go through volatility,
Right.
but clearly financial savings seem to be moving from banks to capital markets. I generally like internet platforms because they go through a low margin phase when they're acquiring customers and when there is competition. But eventually, they are winner take all businesses. Their margins tend to be very, very high. They don't have capex or working capital. So basically, your PAT is free cash flow. I also like what I call mid tech exporters, where it's not commodity based things like chemicals or steel, where China is so big that ROC is not very high and they're very capital intensive by nature. Um, and we can't do very high tech where US and China are dominant. Like we can't export chips, AI chips over, right? Because we don't have the technology. But I think there is a set of industries where a great management team can um, become global supplier, where you need a bit of engineering, you need a bit of science. So these are industries typically engineering exporters, contract research in pharma, auto ancillaries, specialty chem, defense, wherever what we call the white collar workforce of India works. Because ultimately, if you see globally, because of this demographic issue, trained doctors, engineers, CAs are in global shortage, which is why you see the mushrooming of GCCs, the global captive
Correct.
centers in India. Uh, so if you can find someone who can create a bit of a moat around these products and scale up to become a global supplier, uh, I think that is another theme worth looking at.
Right. So you mentioned two, 3 points, and let me take the broader point first, which is about demographics. And it's very often that we have heard you talking about global GDP growth
Yes.
cooling off, India's GDP growth cooling off, and you keep telling the investors also that don't have the return expectation in next decade,
Yeah.
what you got in last 2 decades. Not many fund managers talk this thing. So there are two questions for me. One, is it a homogeneous trend across the world? Or there are pockets like India where we can have GDP growth as well as stock market appreciation better than our past what we have seen in last 1 or 2 decades, because some of your colleagues in the fraternity, they keep saying that the best of India is yet to come. So if you could just help us understand that.
So I doubt we will have, in nominal terms, returns higher than last 20 years, purely because India has actually done a very good job of getting inflation down. But uh, unfortunately, in terms of nominal returns, that depresses stock market returns, right?
Right.
Because see, very long term, if I take 30-year view, Nifty 50 and nominal GDP returns are exactly the same, around 11-12%. Now, the other reason why I think this is happening is basically, in a way, I call it Japanification of the world,
Right.
which is that you have very adverse demographics, you have anti immigration culture, which is again picking up globally. So then basically our workforce doesn't expand, right? And productivity, see, productivity, while apparently a lot of technology and all comes into our life, but when you actually measure productivity, you can't really improve it significantly in a short period of time. So essentially, what is GDP growth? GDP growth is number of hours worked into how productive you were per hour, right? Um, so if number of hours worked is going to go down,
Right.
then a bit of improvement in productivity, but can't be too much. And it's not uniform. Like US, because it has created shale oil, because it has created this huge technology giants, has done well.
Right.
But when you see Europe, Japan, who not over last 20 years created all these things, there the productivity has not gone up at all. So globally, I think it will be tough when number of hours worked itself is kind of stagnating.
Right.
Very difficult to believe that we will have high real GDP growth. Um, Now the thing is, we will obviously have cycles, so it's not like things go down in a straight line. In fact, today I think global economy is actually surprising on the positive side versus expectation.
True.
But we should also remember that a lot of the growth, particularly in the last 5 years, has come through a very, very unprecedented expansion of fiscal spending.
True.
So when you see the government debts of the government of the countries, as a percentage of GDP, a lot of the developed countries are above 100%, which is historically a very, very big number. Now, one thing you have to think about is how sustainable is the growth we're seeing, because if it's being financed by this massive expansion of fiscal deficit, if, for example, bond yields, and you are beginning to see that the 10-year and 30-year bond yields are becoming very sticky even when central banks are cutting rates.
Right.
So I think we have to be very careful about these things. So I'm not investing with a view that the nominal GDP of both the globe and India will be equal to or higher than last 20, 30 years. I generally believe it will be lower.
Got it. So you mentioned a couple of interesting points, and that's where I would discuss the last questions. But before that, I would want to understand more on one subject, which is your favorite, and where we all track you a lot, which is small cap.
Yeah.
Now, if I look at last 1.5, 2 years, uh, most of your colleagues in the fraternity, they were mentioning that small caps are expensive. Even if you have SIP, you can stop. If you have allocation there, book profit and all those things. But you were one of the lone voices where you said it's not a homogeneous field. Look at stock specific areas. There are still opportunities in small cap. The tailwinds are supportive. If you have a 8-10 years view, small cap should be a meaningful allocation in the portfolio. Now investors are confused because they didn't get any return in last 1.5 year, though I should say that you have been beating benchmark to your credit. So where should small cap be in my portfolio at current juncture?
So let me clarify what I meant by that.
Right.
Look, my if I take a 10-year view of the market, we are obviously starting at fair value. I don't think we are too much overvalued. We are too much undervalued. The reason I say that is, I think the best metric to look at stock market cycle is what has been the return above inflation, what we call real return,
Right.
over the last 10, 20 years. So today it is about, on 10-year basis, 7.5, on 20-year basis, 6.5, which is exactly the global average, right? I mean, every country broadly has this real return on a long-term basis. So it's not distress valuation, but it's not very expensive. So if I take next 10 years, then I will broadly assume that same average, which means that given that inflation is lower now, maybe all indices, large, mid, small, will do about 10-11%, which is much lower than, as I said, last 20 years, which is 13-14%. Uh, so if your nominal GDP is coming down, your large cap, mid cap returns in nominal terms are lower.
Right.
And the universe and quality of the small cap space has expanded massively over the last 15-20 years. So today, if I, let's say, use a cutoff of 3,000 crores, which for our size is difficult to invest, and reasonable growth, reasonable quality of corporate governance, then we have probably 600 to 800 stocks.
Right.
We obviously don't cover all of them, but I think they're there. Now, question is, if your ask rate is only 10%, out of the 600, 800 stocks, can we build a portfolio of, let's say, 150 stocks which can beat 10% per annum? That's all you need to beat, right?
True.
Um, I think that is the only way to create big return to my mind. Because, uh, see, with demographics stagnant, I mean, more or less speaking out, nominal GDP very tepid, it's going to be very difficult for large and mid cap indices to generate very high return. Um, so when I say this, I don't mean small cap index will do gangbusters. Actually, a lot of people think that I'm positive on small cap because small cap index will do 20% per annum. It's not.
Right.
It may do 10, it may do 13. I don't care.
Right.
The whole point there is, see, India is a very peculiar stock market.
Right.
Most developed markets, the number of stocks don't expand.
Correct.
In fact, in US, a lot of buybacks
Contraction.
happening. People go private, right?
Right.
Somehow our ecosystem has evolved where a lot of companies get listed quite early,
Right.
I mean, they get listed at 300, $500 million market caps, which usually is not market cap at which stocks get listed in the Western world.
True.
So it gives you a lot of choice. And due to various issues or various trends, the quality of small caps has gone up. So a lot of them, for example, come from the private equity ecosystem, where they've gone through institutional shareholding, where board quality of the board, quality of corporate governance has improved because of private equity presence.
Right.
So I'm just saying that unless you do that, then in a Japanified world, the index is not going to do anything much to my mind.
So you're making a case of active versus passive also, and you're
Yes.
making a case for smaller companies versus bigger companies.
See, other point here is the only place recently where large caps have outperformed is US. But the point there is that's purely because they were able to create these gigantic uh, tech behemoths,
Right.
which only one country or two countries can do.
Right.
See, India's broad profile of industries is very linear models. Like we don't have too much of IPR where like Nvidia or Google we can create, right?
Right.
So let's say a bank or utility or IT services company, they scale up correlated to their factors of production. Like if IT services company has to grow, it needs to hire people.
Right.
If bank has to grow, it needs capital.
True.
So, if these are very linear business models, as they said, trees don't grow to the sky, right?
Right.
Because you should be able to find smaller trees that become bigger trees.
I agree.
More likely than a tree going to the sky, right? So, if you have a 10 lakh, 20 lakh crore market cap company, which is doing very routine stuff, actually, right? I mean, it's not creating AI chip or the best search engine of the world.
Right.
Then the returns will be very, very tepid, isn't it?
True. So you mentioned multiple times about US and technology. Let me have next question around that. If I look at 2025 and if I look at this year till now, it's a very unprecedented year. Though we talk about unprecedented in a very common lingo these days, but it was very different in a way that India, in terms of equity market performance, was among the bottom quartile. We had precious metal generating return in a
Yes.
year, which is expected in a decade from
Correct.
them. India weakened against US dollar and European currencies in a significant way, which we didn't expect. US dollar in itself weakened quite significantly. So, in this world where you have so much of action happening, as an Indian investors, generally, I'll tell you how we operate. To our growth investors, we tell them that whatever is a non-debt part of their portfolio, 25% of that should be in dollarized assets. It can be precious metal, it can be non-Indian equities,
Yes.
primarily US and of late China also. Does this model need to be revisited? Why I'm asking this question is India is 3.5, 4% of world market cap. Should we have 75% of our allocation in Indian equity, which we are doing with our investors who are growth oriented, or should we reduce it? The reason why I'm asking is that as advisors, maybe we have home country bias. Where would you guide our investors to have how much allocation in India versus rest of the world, especially with respect to equity market?
So I think obviously a bit of it will be customized in the sense that how do, like, why do you need savings? You need it for retirement or funding kids' education or whatever. what is your liability in? I mean, if for example someone wants to go settle in US, the future liability is dollar,
Right.
or you want to fund kids' education in US, then you need a dollar asset to fund that liability. Whereas if you want to stay in India, so I think currency is something which people underestimate how violent it can be, right? Not more so much in 1 or 2 years, but when you see a 20, 30-year horizon, you will find currencies which will half against the dollar, and so very few currencies which will appreciate against the dollar till now. But going forward, actually, I am of the view that first of all, that we live in a world where all assets are not cheap. So whether you see Indian equities, whether you see gold, silver, whether you see emerging market equities after this last year's run, whether you see Europe equities, whether you see US equities, all are none of them are at distressed valuation. First of all, right? I think, unfortunately or fortunately, that distress valuation is difficult to get because when the biggest borrower is the rate setter, like the government today is the biggest borrower, and they set interest rates, there is every incentive for them to run very, very low interest rates versus inflation, right? Which is, again, kind of what Japan has done for the last 20 years, where if you put money in the bank, you just can't beat inflation. So basically, there is incentive for you to move from cash or bank deposits to risk assets. Given the government debts globally, I don't think that's going to change. So I do encourage people that look, nothing is cheap, so you might as well diversify. Also, it's a time of massive geopolitical tumult, so it's very big. It's very, very difficult to predict how currencies will behave. The fundamental of currency, which is current account inflation, they don't seem to work. For example, see, Japan has reasonably good current account. It has reasonably low inflation, yet its currency keeps depreciating because governments want, in a way, to want it to depreciate to create inflation.
Right.
Now, how do you predict that? So I generally feel you're correct that you should have a mix of domestic and foreign assets, a bit dependent on how you think your liability is going to be. But it's good to diversify. Gold silver has done very well, but you can trim it, but I don't think you should go to zero,
Got
right? Because um, whether it's Indian equities, gold, silver, emerging market equities, I think you should have a bit of everything.
it. Got it. So diversification, not just in India, outside India
Yes,
as
the
well.
other reason why I think diversification is important from now on is uh, again the same issue that if governments have debt and they're also facing other issue that technology leads to a lot of inequality,
Correct.
right? If you see in every country, the bottom 50% is struggling.
Very true.
With the result that it's becoming very difficult to predict economic policies of any government because, see, in a democracy particularly, they have a mandate to distribute to the bottom 50%. So whether it's taxation or price controls, so you see US, which was unimaginable, I think, maybe a few years back, talking of capping credit card fees,
Right.
talking of capping drug prices.
Correct.
You see India where tobacco taxation came out of the blue and
True.
hit an industry. So you also have governments which are in a very challenged position, and they can do obviously various policies which may affect one asset class, right? So you don't want to be very concentrated at this point of time.
So, my last question is about understanding risk. And you mentioned some part of it in the last answer where you mentioned about political uncertainty and economic divide being one of the risks which we face as a society. But my question is more on the broader level. Last 5 6 years, whenever there is a risk in the market, it becomes more of an existential risk. At least narrative is like that. Just to give you example, when COVID struck, the idea was that maybe certain businesses will go out of business. Many of us may not see the light of the day. That was one variable. Then came cryptocurrencies versus fiat currency. There was a fear that US dollar and maybe certain other currencies will go out of order. Then Japanese carry trade created a mayhem in the market. Now there is a fear every day that AI stocks will correct. Even if there is a correction of 3 4% in Nvidia,
Yeah.
there are WhatsApp messages around it. So my question is, has the risk actually increased in terms of frequency and magnitude, or is it that we are too much on social media that every risk leads thinks that we think that every risk is an existential risk? So how do I understand
I
risk at
think
this?
it's the latter because when you just see stock price movement, they've actually been very low volatile. I mean, every market, whether
Right.
it's US or India or emerging markets, the volatility actually has gone down. So when you see credit spreads, when you see VIX, which is a volatility measure,
Right.
they are actually at a multi-decade low at this point of time. So I think it's a bit of this social media thing. I think if you were in Indian stock market, let's say 20 years back,
Right.
one or two corrections in a year of 10-15% were given. So
True.
there's nothing. In fact, I see less of that happening in our market. I mean, I think what this is the seventh or eighth calendar year
Correct.
where returns
True,
have been
true.
positive. So actually, volatility has been low. I think it gets talked about a lot more.
And very interesting you said so, because on one hand, derivatives and leverage trade is increasing.
Yes.
Despite that, volatility has not moved up. Ideally, it should have led to a higher volatility, but that's an
Yes.
interesting perspective.
Now, I go back to this that the governments are so leveraged that they also can't afford a recession in one sense, right? Because what happens in a recession, your tax revenues collapse, but your government expenses don't go down.
Right.
So you see the fiscal deficit expanding in. So if you take this example of a Silicon Valley bank, the rapidity with which they saved it
Right.
was not when Lehman happened. Right?
Absolutely.
So I think the governments are also not wanting to shake the apple cart in one sense because they know that with their debt, if there is a big accident, you don't want a recession. Although, see, wanting something is one thing,
Right.
being able to achieve it is one thing. At some point, something may happen which may create a recession, but there is obviously, I think, a lot of focus of government to try and keep things stable.
Makes sense. So, with this, we come to the end of our conversation, and what an enlightening conversation it's been. I mean, you not only covered the funds which you manage, but broader economic scenario, not just for India, but for the entire world as well. And with this, we come to the end. Thank you so much for taking out time. Just one last request: any parting thought for our investors? Because, like you said, social media or the flow of news is so high that often we get confused about what should we do with the portfolio. So maybe any parting thought from you which can help ground our investors in a way that they don't feel very anxious.
So I think, see, when people look at equities, they look at return, return, return.
Right.
I think the three R's in equities are actually risk, risk, and return. I think just manage your risk, spread your risk, and do asset allocation in a disciplined manner. I think things will be fine.
And that's where I think fund managers like you come handy. Thank you so
Yeah.
much for taking our time, sir.
Thank you.
And thank you all the viewers for listening to the conversation. I hope there would have been a lot of takeaway for you, because for me there have been a lot of learnings from this. Thank you so much.